I want to discuss the benefits of having diversified portfolio, not just concentrating your portfolio in tech stocks. So do me a favor, post in the chat your favorite brokerage platform. Is it Robinhood? Is it Fidelity? Is it E-Trade? Is it Webull Interactive Brokers? Whichever brokerage account you have that you like the most, please type in the chat. Tell me which one you like the most, or which one works best for you. So I want to look at the benefits of diversifying your portfolio. A portfolio can drift tech heavy without you choosing it. If you look at this chart, 10 years ago, thereabouts, concentration of tech stocks in S&P 500 was 12%. It kept going up 12, 22%, 30%, then went up to 34 and to 40% as of 2026. So if you are looking for diversification and then you keep all your money in S&P 500, now you have 40% exposure to tech stocks. And this tech stocks is largely Mark 7 stocks. So right now, over the last 5 days, the stock market has been taking a hit. Crazy sell-off, especially tech stocks, semiconductors, AI, hyperscalers, heavily hit, except for maybe Apple. All right, Apple, yeah. So you are getting so much exposure right now, from 12.3% to 34% as of today. So as of 2025, so 2026 is up to 40% concentration. Remember, SpaceX is going to Nasdaq the first week of August. So that tech exposure is something you don't want to gamble with. All right, it's something you don't want to gamble with in your account. So what we're just trying to emphasize is that owning index today is just like owning a concentrated basket full of tech stocks. If anything happens to the tech sector, your portfolio is going to be heavily hit. So there are 4 ways and all tech stock can tilt your portfolio. There's a correlation risk. All right. So the same rate shock that hits valuations also pulls the AI narrative. And because everything is correlated, there's nowhere to hide inside a tech-only portfolio. Correlation risk, valuation risk, rates and macro sensitivity, single theme fragility. These are risks that you are inherently susceptible to when you are exposed to just one sector of the market. This one sector of the market is heavily built around Mark 7. We call them Magnificent 7. So if anything happens to any of those Mark 7, it's going to drastically affect your tech, your S&P 500, your index fund portfolio. S&P 500 SPY, VOO, QQQ, just those dives, SMH, those are like ETFs that are heavily focused on semiconductors, on tech stocks. Valuation risk is not a prediction that these are bad companies. They are excellent companies. It's just that the price already assumes excellence continues. So during earnings season, if there is a story that doesn't augur well with the investors, they're just going to dump the stocks. All right. So why growth stocks? Growth stocks, this was that defense against massive sell-off on red days. So in 2022, it was recorded that Nasdaq fell about a third, while value, staples, energy sector held much better. So that gap is the main reason why we are emphasizing it to diversify. So you are not just choked up in one sector. So on red days, you still have other stock that is helping you to handle that decline in market values in your portfolio. So when interest rates rise, those distant earnings are discounted more heavily. High growth tech stocks fall the hardest. But you don't want to be in that situation. Ask money managers, ask retail investors that have all their stocks concentrated on one sector of the market. It's not always a good, especially if the stock is heavily focused on tech. I mean, tech is the most volatile right now. So there's a need to have a balanced portfolio. So there's a need to have a pattern. A couple of years back, 2000 to 2002, that was a dot-com bubble. A lot of businesses were impacted. A lot of investors were impacted. Investors who held only the leaders waited many years just to break even. So just imagine if you have a portfolio of $2 million. You have gains on what do you call that term? Yeah, so you have those gains, but you've not sold them. There's a terminology for them. I'm trying to remember that. So you have not sold the gain, so you have like $600,000 gain. But you're just looking at it. You didn't sell. Oh, it's growing. My stock is growing. My market is growing. And then you find yourself in the dot-com bubble. Everything just wiped out. It took people years, 5 years, 10 years to break even to their initial point before dot-com bubble. So diversification is the insurance against that kind of disaster. Diversification is the closest thing to a free lunch. Gives you a smoother ride, return sources that rotate, you get value, you get dividends, you are able to hedge. Those are defensive plays. So you are adding, you are not selling everything. The goal is to balance, right? So you can take from the profit on your tech stocks, use them to buy growth stocks, use them to buy or stuff from other sectors of the industry that have the capacity to hold in the time of a sell-off. So if you look at this slide here, this block here, so there are different drivers that are beyond mega cap, Magnificent 7. So you have the consumer staples, you have healthcare, utilities, financials, energy and materials, international. All right. So for instance, consumer staples, Amazon might fall in that line. Shopify might fall in that. Healthcare, AbbVie, CVS Health, United Healthcare. Those are nice healthcare companies you should have on your radar. Then utilities, waste management. Waste management is another excellent utility company that you might want to have on your radar. Constellation. Okay. Then financials, banks, payments solutions, MasterCard, Visa, Bank of America, Wells Fargo. So those are financials you can use to hedge. So any stock here, you can use them to hedge your tech stocks. Energy and materials, Vertiv, GE Vernova. I think there is also this one, Comfort Systems, something like that. I think Comfort Systems. So those can fall under energy and materials. Then international stocks. So maybe you want to go into Europe, ETF, China ETF. So those are other ways you can use to hedge. All right. So how do we hedge? You can hedge, all right, by diversification. So dividends and bonds pay while you wait for the stock to grow. You can also consider gold and real assets. Okay. You're looking for stocks that are big on dividend, like energy trade, energy transfer. It has like over 6% dividend yield. So if I'm just looking for something that can stand the test of time and still has appreciable amount of dividend yield, then you can consider energy trade. You get like 7% thereabout in dividend that is paid periodically. I think it's paid every month. So sometimes this can be a fund and not an individual pick. If it's an individual pick, all well and good. Okay. Sometimes you have equal weight index. They are less concentrated and they are not really exposed to the risk of tech stocks. So what you need to do is to rebalance. If you find yourself over concentrated in one sector of the market, you want to rebalance your portfolio. So look at your portfolio. You don't want to, so don't turn your portfolio to a hedge fund. Maybe between 10, 15 stocks is good. Even 10 is okay because you're not a Wall Street person. You don't want to just have too many stocks in your portfolio and then you can't even keep track. Where you have less stocks in your portfolio, you are able to manage them. You're able to move money around. You use the house money to settle the house. You don't have to go and bring money again since your stocks are growing. You can take the profit and go buy something. So always rotate around a specific number. So how much tech do you have in your portfolio right now? So look through your portfolio. If you have index stocks, index funds, what is the concentration of tech exposure in your index funds? So continue to repeat this periodically. So the key mindset here is to ensure that you systematically rebalance your portfolio, reassess your portfolio, reevaluate your portfolio. All right. Trim winners back to target at set intervals. All right. Make sure you are able to track roles. Follow up on news. The internet is there. Google is your friend. Copilot is your friend. Use all of this to get information on the latest. Attend earnings calls. All right. So this is a typical portfolio that is a balanced diet. Well balanced. So this is not an advice, but you can start from here. So here, 40% in equity. So value dividends 15%, defensive stocks, international exposure 15%, bonds 10%, real gold and assets 5%. So it doesn't necessarily mean this is what you should do, but at least it gives you an idea of what you're trying to emphasize. So a core of broad equity still captures tech's growth, while roughly half the portfolio sits in holdings that behave differently. So if there's a swing in the market, you are not heavily hit. There's still some cushion to help you adjust to those swings on the red days. All right. So I'm not asking you to sell your tech stocks. Just look out for your level of exposure and then see how you can move things around. If you are heavily concentrated on tech, see how you can bring in non-tech stocks to help you hedge just to prepare for the day of sell-offs, so you are not heavily hit. So the market has narrowed. 7 tech names as a third of S&P 500. That means your risk compound, right? If rates changes might affect your values, your portfolio. Of course, this era of AI, any little trigger can mess up your portfolio. You don't want that to happen. So look for non-tech stocks. It helps you to counterweight your portfolio, create a defense, a hedge against a market sell-off, against a fall. Okay? Then discipline yourself. Don't be emotional. Don't be an emotional trader. Don't be emotionally attached to your stocks. Once the valuation does not align, once the story does not align, once leadership is not coming up front, once they are not meeting your expectations, start looking for the next best thing. Right? So that is what I have to share on this one. I will see you on the next one. Take care.